As we start 2024, one of the stocks that I still think has a lot of potential is Verizon. Now, shares have rebounded a little bit over the last couple of months, but if we look at the company's valuation, the price to earnings multiple is still in single digits. The dividend yield is 6.6%, and I just think this is a very sticky business with a lot of potential to grow in a number of different areas. So, today I want to dig into Verizon, what I see from a valuation standpoint, and for the potential for the company in 2024 because there's both opportunities and risks with a business like this. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And I want to start this by just going back to the most recent quarter and some of the information that we found out, the trends that we see there from the business. Now, I want to start with the operating trends, and I'll get to this before I cover the financial trends because operations is really where there's some question marks about where Verizon is going to go in the future. And this piece right here, specifically the consumer postpaid business, is I think where there's the most questions by the market and investors in general. And that's because there's a lot more competition today in telecommunications than there was a few years ago. So we have the oligopoly in the wireless market with Verizon, AT&T, and T-Mobile. That's pretty clear. But the big player that has come into the market is the cable companies. And they're able, and for a variety of reasons, they're able to undercut companies like Verizon because they have a deal with Verizon to buy access to their network on just a per minute basis. And they can offload some of that content with things like Wi-Fi and also building out their own networks on a more localized level. So some customers, especially those lower value customers, are going to be moving to products like that and bundling with cable TV, cable broadband, and then cable wireless as well. So I think that's one of the reasons that you're seeing weakness on the consumer side of the business. On the flip side, what you are seeing is additions on the business side. And Verizon is in a unique position in this market specifically because they're actually the ones that are serving those Comcast customers. So for a number of reasons, business connections are actually doing a little bit better than consumer connections. I'll get to the finances behind this in just a second, but that's the general trend is weaker with consumers, better with businesses. Where there is a lot of strength is in broadband. And there are two pieces to this. One is wireline, that is Fios or fiber, and DSL, that's in red right here. And you can see there's additions, but there's not all that many. The second is fixed wireless access. This is something I've been using for quite a while now. And for me, it was better than Comcast cable internet. And so that was one of the reasons that I was intrigued by this. And the momentum in this business has been really strong, adding over 300,000 customers per quarter. Now, there's a limit to the growth here because you're bumping into the capacity limits of the network. But this is also an area where if Verizon has capacity problems, they can simply add capacity in the areas where they need it. It isn't as difficult as adding capacity for something like cable or fiber where you have to run a line to everybody's house. So I understand that there are concerns here and how much growth there is in fixed wireless broadband specifically, but ultimately I put this under the engineering problem and not physics problem. So basically this is a solvable problem if there's demand for these kinds of services. So this is where we're seeing a lot of momentum, and I'll get to where the financial impact comes in just a second. Prepaid net adds, again, another point of weakness is those prepaid services where people are paying ahead. And again, these are typically lower margin customers in the past. Where this churns out in the financial statements is the total wireless revenue. So all of those pieces that I was just talking about, you add all of it together and revenue is actually up 2.9% from a year ago. So a lot of this is being driven by that fixed wireless business. 2.9% doesn't seem like a lot. But in the wireless business, any amount of growth that you can have is going to be positive. So there is positive there is positive momentum on the revenue side. And the reason that we're going to look at this wireless segment is because this is actually very, very high margin. They spend billions of dollars to build out the network, but then every dollar of revenue is going to be in the software level of margins in that 70-80% range of gross margin. It doesn't actually cost a lot to run that network on a day-to-day basis. So this is going to be a very high margin business. On the other side, the wireless equipment business is actually typically a break even or money losing business. When you go buy a phone from Verizon, they typically lose money on that transaction, and they more than make up for it by selling you that wireless service over the next couple of years. So that's typically the way the business runs, razor blade model. Now, the change over the last year has been Verizon pulling back on the amount that they have to spend on capital expenditures. Remember, the last few years was dominated by that 5G build out. So not only buying spectrum, but also building out the towers and the equipment that is required to actually operate that network. So that's cash going out the door, and cash coming in the door wasn't growing, or cash from operations weren't growing at quite the same rate. So you can see this is relatively flat. Cash from operations, $28 billion over the previous 9 months, ended at the end of September 2023. Capital expenditures, though, starting to come down. A different look at that is this chart right here. And this is where you see free cash flow on a quarterly basis. The previous numbers were just the last 9 months. So you can see over the last 4 quarters, there's been a sharp increase. And right now, $6.7 billion per quarter. So we're getting into that $25 to $30 billion per year range in the amount of cash flow that's coming into the business. And that should continue to improve throughout the end of 2023 and then into 2024.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So that gives an idea of where we are from an operational perspective. Now, it's going to be really interesting to see if some price changes that Verizon made over the last few months and the holiday season, new phones, changes anything about the additions to the network or the margins from the customers that they have over the next few quarters. I just changed my plan on Verizon, and I'm actually paying less per month than I was previously. So there could actually be pressure as Verizon tries to compete on price with some of these other competitors like the cable companies. And the other thing that I'm going to be watching this year really closely is what happens to the company's debt. Now, free cash flow is increasing, but then it's what Verizon does with that free cash flow that's going to ultimately be really important. So there's 2 main things that Verizon's doing with its cash flow. It's paying out the dividend. I mentioned the 6.6% dividend yield. That's pulling nearly $3 billion per quarter of cash out of the business. So they have to generate that kind of cash just to pay the dividend. The other thing that they're doing with cash is trying to pay down debt. Now, let's look at a chart of this. This chart goes back to December 2020, so 3 years on a quarterly basis. And there's 3 components here. The red is cash and equivalents. Blue is the current portion of long-term debt. So that's long-term debt that is due within a year. Pretty big number, $14.2 billion due within the next year right now. And then long-term debt overall, that would be more than a year, $137.2 billion. So if you add those 2 things together, the debt level has actually been pretty flat since the beginning of 2021. It has come down slightly, peaked at about $158 billion, and is now about $151 billion. But again, interest rates have risen over that time. So there's really a balance there. And Verizon needs to start reducing this debt load, because as they have to refinance this debt, it's going to be more and more expensive. So one of the things I'm going to be watching is what happens with this short-term debt. Are they able to eliminate that? Do they have to refinance at higher rates? That's going to be a huge risk for Verizon in 2024. Now, I think at the end of the day, the value here in shares of Verizon is just too good to pass up. And that's the reason that I stay invested in Verizon right now. I mentioned earlier the price to earnings multiple on a trailing basis, 8.1, on a forward basis, 8.9. The company is starting to pay down debt, so the enterprise value is starting to decline a little bit. And they always have the option to reduce the dividend payout to pay down debt. That's something that I have argued for in the past. I think a lot of investors who hold Verizon just strictly for that dividend probably wouldn't appreciate that. But I think that's an option that should be on the table, given the fact that interest rates are significantly higher than they were when a lot of this debt was taken out over the last 10 years. So plenty of risks for Verizon, but the value of the stock and the dividend and the cash flow that's coming from the business, I think is too good to ignore. And that's why I'm still in Verizon stock. I still think this is a stock that can outperform the market in 2024, given the value that investors are getting today. But what do you think? Leave your comments about Verizon in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.